Good morning, hello and welcome to this Money Controls live stream. You're tuned into a fresh new edition of Opening Bell with me, Lovisha Darad. And we are back with a fresh week and lots of triggers that is lined up for this week too. It's going to be a busy Monday too, as more earnings are lined up. Some trade talks are expected to take place in Stockholm. So yes, lots of things that we will be watching out in today's trading session. But yes, coming to the trends in the GIFT Nifty, it is indicating a muted start for India. We've had fourth consecutive weekly loss for Nifty and a second day loss too. Below that 24,900 levels. So we'll watch out whether or not we are able to bounce back to 25,000 at this point. But yes, the numbers so far has been uninspiring from India Inc. And investors are now more worried whether valuations are good enough to support and fuel any rally in the markets, because we see any recovery in the markets which is taking place, it's getting sold on to. So far, we have had IT and banking numbers which have delivered the first quarter performance, and we'll be heading to some of the more auto and defense numbers which will be getting reported this week too. So we'll be keeping them all under our radar as well. Now, while India's quarterly performance continues to remain a mess, US earnings have been pretty strong, with majority of them surpassing Street's EPS estimates. And that's why we have seen that S&P 500 has been hitting record highs day after day. So basically, so far this year, S&P 500 has hit about 14 record highs for the index itself. But yes, coming to how Asia Pacific markets fared this morning, that has been mixed. We have US-China trade talks which will be taking place in Stockholm later today, and we'll watch out if there is any more developments which is related to the trade negotiations. So yes, so while the trade deal with China has already been taken place, Japan has been already announced, and now EU too, India is still hanging, and August 1 tariff deadline, that seems to get nowhere, and that seems to get no extension. That's what we have been hearing from the White House too. But yes, throughout the show, we will be also discussing about some stocks in focus. Kotak Mahindra Bank announcing its results over the weekend, Shriram Finance too, and we'll also be taking your stock-related queries, so keep posting them on our live feed. Now, let's take a quick look at the top headlines, Sir. US markets witnessed another positive session on Friday as key indices finished with gains, and the S&P 500 notched its 14th record close. Asia Pacific markets are mixed this morning ahead of US-China trade talks scheduled later in the day, while the GIFT Nifty is indicating a muted start for our own markets. Crude oil prices cooled to a three-week low, and as talks between US-China take place, gold prices meanwhile fall ahead of the US Federal Reserve meeting, which is scheduled later this week. The US and EU have reached a trade deal which will see a blanket 15% tariff on all European goods imported to the US. This comes after US Commerce Secretary Howard Lutnick confirms that there will be no extensions to the looming deadline of the tariffs. And in Money Controls exclusive, we've had TCS, which will be laying off 12,000 employees over the next year, cutting off 2% of its global workforce, primarily in the middle and senior grades. The CEO has described the decision as the toughest, but said that it is important towards building a future-ready company. And in earnings front, Kotak Mahindra Bank reported June quarter numbers over the weekend. The bank's net profit missed street expectations, while the net interest income also rose by about 6% on a Y-on-Y basis. All right, we saw in the last trading session that the Nifty did plunge for the second straight day, and in the last week itself, we saw that the markets clocked about the fourth consecutive weekly decline. If you look at last session's levels, Nifty shed about 200 points below that 24,900 levels, and if you look at the broader end of the markets, both the mid-cap and small-cap indices also saw a cut of about 1 to 2% each. Among the sectoral indices which did well, that was the Pharma Index, which ended in the green in the last session. However, the PSU Banks was the worst performer of yesterday's trading session. On the other hand, if you look at some of the Q1 results which will be reporting this week, we have IndusInd Bank and Bharat Electronics, which will be reporting its June quarter performance. Eicher Motors, Hyundai, HUL, ITC are some of the other names that will be reporting their first quarter performance. But yes, all eyes will be on the Federal Reserve's interest rate decision, which will be out in 2 days. So we'll be watching out. The street pegs that the interest rates are expected to remain unchanged this time as well. But we'll watch out of the future outlook and, of course, how the tariffs have been impacting the US economy itself. But yes, more results from the US. Meta, Microsoft will be reporting their results on Wednesday. Apple, Amazon will be reporting on Thursday itself. So yes, the Magnificent Seven will be reporting their results for this week, and we'll be watching out for those numbers. But coming to the fund flows data, once again, the FIs have stood out as net sellers. They've sold stocks which is worth about 3,000 crore rupees in the cash markets. DIIs, however, they stood as buyers with about 1,800 crore rupees mop up in the cash markets. Option Q's data, Nifty put call ratio has fallen to about 0.7 from 0.9 levels, and the stock that continues to be a part of the F&O ban, that includes your RBL Bank and IEX, has been out of the F&O ban list. But just less than 2 minutes to go before we hit the open. But let's take a look at how the pre-open rates are looking like at this point of time. Both of the headline indices have been showing a negative trend. Sensex down about 160 points. Nifty below that 24,800 mark as well. But on that note, let's quickly get on board with our technical expert of the show. Joining me is Rajesh Palviya of Axis Securities. Rajesh, good morning. Now that we have Nifty below the 24,900 levels, how does this week look like?
Good morning, Lovisha. So, looking at the previous week fall, we believe that if he continues to trade below 24,900, I think further more round of selling pressure we could witness in the coming days, as we are in expiry week for this series. And looking at the data, we have already broken the important put base concentration at 24,900. So 24,900 may act as a immediate steep resistance for any minor pullback action. Nifty now trading below to 20-day, 50-day moving average, which is also adding up a bearish view for the near-term perspective. FI long short ratio is also indicating that they are still holding their short position, and looking at the addition in the short position, it clearly indicates that we may see further more downside. So on the downside, below 24,800, the downside is open for the next target towards 24,700, even 24,650 kind of level in the continuation of this down move. Even on the Bank Nifty, we have seen, now Bank Nifty is decisively broken its important support area of 56,800. So I think below 56,800, there is a possibility that we may see further lower level towards 56,300 to 200. That's the next important support area for Bank Nifty also. So I think some more supply pressure is likely to be there until the Nifty not crosses about 24,950 and Bank Nifty not crosses above 56,800.
All right, we 56,200 support coming in for Bank Nifty. But yes, the first rates coming on your screen, we have opened in the negative terrain. Nifty below that 24,800 levels. 0.2% cut coming in from the Nifty 50 index too. If you look at Sensex, that is also open with about 100 points gain, 100 points down tick. So yes, right now, if we refresh the rates, Sensex is also down about 200 points, and Nifty is also still below that 24,800 mark. But let's take a look at India Wix, because that continues to spike with about 6% gains. We did see that that India Wix was about sub 11 levels, which is about your 10 levels, and that showed complacency. But right now it is seeing a sharp uptick with about 7% nearly uptick for coming in for the India Wix too. So yes, the volatility is on the higher end. On the other hand, if you look at some of the sectoral gainers and movers, Nifty IT index, given that TCS has announced that they will be laying off about 12,000 employees throughout the course of the FY26, so we can see some rub-off effect which is coming in on the IT index with about a percent cut for the Nifty IT. On the other hand, if we look at Nifty private banks, have also taken a setback given the weakness that is prevalent in the Kotak Mahindra Bank results. So Nifty private bank also not doing well. On the other hand, if you look at some of the auto index showing a gain of about 0.3% ahead of some of its quarterly results performance. We have some auto majors which will be reporting its first quarter results. Eicher Motors is going to report its results today later in the week, and then you have Hyundai Motors also reporting its first quarter performance. Let's take a look at some of the other sectoral gainers and movers at this hour. If you look at Nifty Pharma index, it's showing a little unchanged at this point. But let's take a look at Nifty Media, Metals, all of them showing a little bit of a weakness at this point. If you look at small cap and mid caps, but the broader end of the markets continue to show weakness in the today's trading session. Let's take a look at some of the top gainers on the Nifty and on the Nifty 50. Tata Motors showing a good move with about a percent gain. That is doing well today. Bajaj Finserv with about 0.4% gain. On the other hand, if we see ICICI Bank, Tata Steel, Cipla also showing some resilience with about 0.3% gain. So slim gains coming in, but yes, these are the stocks which are showing some resilience in this subdued market. On the other hand, we can see the cuts quite visible on Kotak Mahindra Bank. 5% downtick coming in for Kotak Mahindra Bank after its June quarter performance did miss its street estimates. We did see that the net profit did fall about 6% on a Y-on-Y basis. However, the net interest income that rose. TCS with about 1.4% cut, given that the company has announced a 2% cut in its global workforce. So we can see TCS not doing well in today's trading session. Some of the other IT stocks also not doing well. For instance, your HCL Tech on Tech Mahindra also showing some kind of a weakness. Bharti Airtel and Titan also seem to be the other underperformers in today's market. But yes, let's talk about Nifty IT index, because that was the worst sectoral performer last week, and now we have TCS announcing 2% of cutting its global workforce. Rajesh, how do you see Nifty IT index and of course the TCS and other selective IT stocks? So where are you finding any position it, and how do you expect this sentimental reaction to play out?
So clearly, Nifty IT has given the gain, gave up all the gains which we have witnessed in last couple of week. And looking at the breakdown below 36,000 now, I think the next down move can extend further, as most of the large cap IT stocks are witnessing supply pressure and broken their important support area on the near term chart. So looking at the structure for Nifty IT, I think we may see lower trajectory towards 34,800 for Nifty IT in the continuation of this down move until the Nifty IT not manages to cross above 35,600 on a closing basis. So trend is likely to remain on the weaker side. If we analyze on the TCS or other large cap IT stocks like Infosys, I think both the stock have broken their important support area. TCS is looking weak, looking at the fall in last 3-4 session. Now stock is approaching towards its April 2024 swing low. So I think break below 3080 may take this stock further lower to the 3020. That's the next level where we can see this down move can extend for TCS. So keep watch on this stock below 3080. One can go short also. Until the stock not able to regain above 3150, trend is likely to exhibit on the weaker side for TCS.
Trend is likely to be on the weaker side for TCS. But let's take some stocks in focus. Kotak Mahindra Bank, one of the top Nifty loser. We did see that the company reported its numbers on the weekend, and the profit dropped about 7% on a Y-on-Y basis. However, the net interest income that was up about 6% on a Y-on-Y basis. The profit decline did exclude the gains on the KGI investment that the company saw in the last year quarter. So yes, brokerages have also been quite underweight on the counter following its June quarter miss. If you look at Nomura, that has given out a neutral call on the counter, and they believe that the core bank currently trades at a higher valuations with limited upside, which is seen. And they believe that the asset quality and the margin pressure has led to the EPS cuts of about 3 to 7% of for the FY26 to 28. However, on the other hand, if you look at Bernstein, they've given out a market perform call on the counter because they believe that the quarter was weak across key metrics. The steep NIM compression and the multi-quarter high credit cross is what drove the ROA below that 2% mark. So yes, brokerages have been cautious on the counter, and that's why you can see about 6% drop on Kotak Mahindra Bank. And of course, the stock has been quite range bound past 1 to 2 months as well. Rajesh, what is the view on the counter for Kotak Mahindra Bank? It has slipped below that 2000 mark itself.
So there is a breakdown in Kotak Mahindra Bank. Looking at the daily, weekly time frame now, stock has broken the important support area of 2050. So I think if it's sustained below 2050, I think the downward trajectory is open for the next target towards 1940, even 1920 kind of level. So I think a weakness is likely to be there in Kotak Mahindra Bank until the stock not able to regain about 2050 level. So sell on rise would be the strategy for any kind of minor pullback if it comes in the market. So if you get opportunity around 2000 or 2020 kind of level, you can go short with stop loss of 2050. On the downside, maybe we could see target towards the 1950 to 1920.
Okay. That is the view coming in for Kotak Mahindra Bank. While Kotak Mahindra Bank continues to slide, we have Bank of Baroda, which is showing some kind of resilience in today's market with about 3/10 of a percent gain. If you look at the net profit, that has risen up modestly by about 2% on a Y-on-Y basis. However, the net interest income has fallen nearly about 2% on a Y-on-Y basis. If you look at the net NPA levels, that has improved from a Y-on-Y perspective. However, the stock has been range bound past couple of months around that 240 levels. If you look at how the brokerages have reacted on the counter, Jefferies have given out a hold call because they believe that the rise in slippages from the international loans and higher provisions have fueled the credit costs. On the other hand, if you look at Citi, that has given out an outperform call on the counter. So a mixed verdict which is coming in from the street for Bank of Baroda at this point. But yes, the stock has been range bound around the 240 levels. Rajesh, what is the next level that we can watch out for?
So I think Bank of Baroda is still consolidating in range only. Looking at the near-term, short-term structure, stock is broadly consolidating in range of 235 on the downside and 255 on the higher side. Looking at the near-term, short-term structure, still strength is there in the counter. So I think any breakout about 250 can take this stock further higher towards 258, even 265 trajectory. But I think looking at the market condition, we may see further more consolidation for next couple of weeks. So I think buy and accumulate would be the strategy. Near-term, short-term structure is still bullish. So if you get opportunity around 240 kind of level, you can buy and accumulate this counter with a stop loss of 232. On the higher side, on a breakout of 250, you can add more position for upside target of 258 to 265.
Okay, all right. Let's take some of the viewer queries that is dropping on our live feed. The first query coming in from Naveen, he's asking that he has 1,000 shares of IEX at about 170 rupees. He's asking whether it is the right time to hold, exit or average the counter. Of course, the stock has seen about 30% crash. Today also the stock is seeing about 6% downtick after the CERC approval for the market coupling, which will be taking place next year itself, and the stock has seen about 30% downtick in itself, like about it's past 2-3 days. So yes, 170 rupees has been holding at, and now the stock has been trading at 130 levels. What do you suggest, Rajesh? What should you do at this point of time?
So very, strong supply pressure we have witnessed in the last week for IEX based on this news flow, which we have seen in the previous week. Looking at the near-term, short-term structure, there is a clear sign of weakness. On a medium-term perspective, also stock has broken the important support area of 160. So I think trend is likely to exhibit on the bearish side only till the stock not able to regain above 160 zone. And if we analyze overall structure for the stock, stock is remain underperforming stock only. So I think one should not average it out as still shorts are there in the system, and maybe we could see further more pressure in the counter if it's break below 125 kind of level. So 125 is the critical level on the downside. If it's break below 125, I think downward trajectory will open towards 110, even 105 kind of level. On the higher side, 155 to 160 would be the major supply zone for the stock if any pullback comes in this counter. But looking at the structure, I think don't average out. We may see, further more underperformance in this counter in the coming weeks also.
Furthermore, underperformance is likely for IEX, so we'll watch out for that counter. Let's take another viewer query then. Debuke has been asking the view on K FinTech. Past 1 month, the stock has been on a sliding negative trend, a 14% downtick that is coming in for K FinTech. Rajesh, can we expect the pressure to continue for the near term?
So stock is now trading near to its crucial support area of 200-day moving average, 100-day moving average, which is placed at around 1150 kind of level. And almost stock is trading around those level only. So I think one needs to watch this level closely for next couple of days. If it's any breakdown happens below 1150, 1140 kind of level with the volume action, then we could see further more liquidation in this counter. If at all stock able to defend this level, so I think some pullback we may see towards 1200 to 1240. That's the next level on the higher side. So 1240 is likely to act as a major supply zone for any pullback if it comes from these level. So keep watch on this price 1150 where we are trading. So that level is very important level for the stock for near term trend.
Hmm. Okay, all right. That is the view coming in for K FinTech. Let's take another viewer query. Naveen has been asking the view on Bajaj Finance, and he's asking what are the entry levels for the long term, at least for 1 year or so. Bajaj Finance, of course, we have seen that after the Q1 results, the stock is seeing exhibiting some pressure, given that the management has seen some stress build up in its MSME portfolio. But yes, Rajesh, what is the view on the counter, at least for the long term or at least for the medium term, at least?
So for long term, stock is in bullish trajectory only. Yes, for near term, there is some pressure as whole BFSI space is witnessing supply pressure, and stock is also exhibiting the same kind of behavior in line with the sector. Looking at the long term trajectory, I think if you get opportunity around 850, 860 zone would be again, the right level to buy and accumulate the counter. And once stock crosses above 950 zone, I think it will resume its uptrend, and then we could see further, new all-time high trajectory also for the counter. So buy and accumulate would be the strategy. On the downside, 840, 850 should be your stop loss. Breakout above 950 can give, new all-time high trajectory also for the counter. But yes, for long-term perspective, yes, one can look to buy this counter, and in decline, one can buy and accumulate.
Okay, buy and accumulate this counter on every decline for the long term then. Let's take another viewer query. Then Alex has been asking the view on Cient and whether it would retest its major support levels. Of course, the stock has been stuck in a range and it's an underperformer so far this year itself. 1300 to 1250, that is whether it has been stuck, the stock. But yes, Rajesh, what is the view on the counter for Cient?
Yeah, so Cyient is also witnessing some bit of consolidation. If you look at the monthly setup, since last 3 4 months, the stock is stuck in the range only. So for upward breakout, stock needs to cross above 1320, 1340 zone with a volume action. Above 1340, yes, there could be a breakout on the short-term chart, and then possible rally can extend to 1400 to 1440, 1450 zone. But till this breakout is not happening, I think we may see further more consolidation. As you rightly pointed out, that yes, on the downside, 1240, 1230 would be the immediate support area for the counter. So buy and accumulate would be the strategy, but keep a strict stop loss of 1220 if you are buying and accumulating this counter. Breakout about 1340, you can add more position. Then we could see rally towards 1400 to 1440.
Okay, all right, 1440. Let's take another viewer query then. Anunya Iriki is asking the view on CDSL. He's asking whether he should book profits because his buying price was about 1340 rupees, or he should hold. 1340 was his buying price, and right now the stock has been trading with about 1569. Today also the stock is seeing some pressure after its first quarter performance has missed some of the street estimates. Past 5 sessions also the stock has been on a declining trajectory. Rajesh, what do you suggest? Because we also have NSDL IPO which will be opening up.
So in last couple of week, we have witnessed, supply pressure in most of the capital market related stock, and CDSL is also one of the proxy play for capital market, and I think the same kind of behavior we have already witnessed in this counter. Stock has broken the important support area of 1600 on a weekly closing basis, so that's the negative development on the near term chart. But yes, as NSDL IPO opening would be the immediate trigger for the counter. If anything, positivity comes in this IPO, and I think the peer as a peer company, I think some relative performance would be there in this counter also. So one needs to closely watch how this response for this NSDL IPO gives by the street. Looking at the near term structure, 1530, 1520 is the immediate support area. If stocks breaks below that level, then we could see more liquidation in this counter on the higher side. As I mentioned, 1600 to 1620 would be the supply zone. Any breakout above 1620 can give further more pullback towards 1700 to 1740. If your horizon is for long term, yes, you can remain invested. And if you want to add the position, any decline towards 1500 or 1480 would be the again opportunity to buy this counter for long term perspective. So we are holding bullish view for the long term perspective, but for near term there could be some volatility in this counter.
Okay, all right. Let's take another viewer query then on that note. Dheeraj Sharma has been asking the view on Saxoft, and he's asking whether he should hold, average or buy the counter because he's got the holding of about 202 rupees and that was his buying price. Of course, the stock is down today and in the past, however, in the past 6 months, the stock has been doing quite well. From May lows itself, we can see the stock is on an upward trajectory. What do you expect, Rajesh, for the counter? Can we expect the momentum to continue?
So there was some corrective move in this counter, but if we analyze on the long-term chart, strength is still there in this counter. On the monthly chart, his stock is holding the breakout. So 202, if he has bought, it's a correct price for the near-term perspective also. So I think he may hold on the position as stock is comfortably holding above 50-day moving average. So if you want to place any stop loss, 190 should be your stop loss. If it breaks 190, then yes, we may see some more liquidation in this counter. But trading about 200 is a positive sign for the counter on the near term to short term perspective. There could be a chances that stock may attempt to give some pullback action from the current level. In pullback, if it's able to cross about 230 to 35 level, then we may see further extension of rally towards 260 to 70 also. But yes, keep stop loss of 190 for your position which you have bought at lower level.
Okay, 190 is a stop loss for Saxoft, all right. Just one last question before we let you go, Rajesh. Any topics that you want to highlight at this point of time, given that we are in the thick of the earnings season also?
So Paytm is looking attractive. I think the way stock is showing outperformance, I think we may see further more outperformance in this counter towards the end of this series. The kind of breakout we have already witnessed on the short to medium term chart indicates that this stock has potential to continue further towards 1150 kind of target. So buy and accumulate would be the strategy with stop loss of 1040. Another stock is looking attractive from the chemical space, that is Tata Chemical. Here also stock is now negotiating with its 200-day moving average supply area, which is placed at around 958. So I think any breakout above 958 can take this stock further higher, and possible target towards 1000 we may see in the near term to short term perspective. So Tata Chemical is also looking attractive with stop loss of 935. And one stock from the mid cap space, that is AGI Infra Limited. Here also we are seeing that stock is trading at its 52-week or high trajectory. Looking at the breakout on the weekly as well as on the monthly chart, we believe that if it continues to trade above 1040, maybe a rally can extend towards 1145 to 1160. So AGI Infra is also looking attractive from the mid cap space.
That is the view coming in for all the stocks right now. All right, Rajesh, with that, we have to let you go. Thank you so much for your time, and we hope that we connect with you soon.
Thank you.
All right, if we take a quick check of the markets, we have trimmed some of the losses that we saw. However, both of the headline indices continue to trade flat at this point of time. Nifty IT index particularly, which saw a sharper cut of about 1%, is now trading with about 0.5% loss. But yes, in a big money control exclusive, we did have MD and CEO Kriti Nivasan talking about how the TCS has decided to cut about its 2% of its global workforce, which will be impacting about 12,000 jobs in FY26 itself. We have Debangana Ghosh joining in with more of these exclusive details about how the MD and CEO has discussed about the productivity shifts and whether or not these layoffs have been driven because of the AI-led productivity gains. Debangana, off to you.
Thanks for having me on the show, Lovisha. Firstly, just to highlight a very interesting point the CEO has mentioned was these layoffs are mainly going to happen within the middle to senior level staff and not necessarily the entry level. Yes, entry level employees are going to get impacted, but it's mostly going to be on the basis of who has spent more time on the bench. And the other interesting point that the CEO during our interview had highlighted was that these job cuts are not necessarily directly related to the AI productivity gains or the efficiency gains, but it is more to do with requirement for specialized skill sets, or rather more a mismatch of skill sets at the moment, because there's so much of the emerging technologies coming up and clients requiring those. So TCS is kind of finding it difficult at the moment to redeploy certain employees, and it's especially so with the senior level employees.
All right. All right, that is the view coming in. And of course, thank you, Debangana, for joining in. It's a big money control exclusive, and that's why we can see an impact on the Nifty IT index itself also. TCS with a cut of about 1%. But thank you, Debangana.
Thanks, Varma.
All right, let's take a quick check of the markets before we move on to our next guest of the show. We have the headline indices, which has been trading with a loss of about, Sensex down about 58 points and Nifty still below above that 24,800 levels. We were below that 24,800 levels early in the session, but right now we have gained and recouped some of the losses. If you look at some of the sectoral gainers and movers, Nifty Auto Index continues to do well. Bank Nifty, however, with a loss of about 0.1%. On the other hand, Nifty IT Index has trimmed some of its losses with about 0.5% gains. And then you have Nifty Pharma Index and Nifty Realty Index also with a mixed set of performance. But let's quickly move on to our next guest of the show. We have Nirav Karkera, Head of Research, Fisdom, joining us. Nirav, good morning. It was the fourth week of decline for Nifty, and so far earnings hasn't impressed investors. So what is your assessment so far from India Inc.?
So the earnings season has, indeed kicked off on a rather lackluster note. There was a lot of upbeat expectations, I would say, at the start. However, as the results are coming through, it seems like we'll have to wait for much longer for the revival that we hoped would kick in this set of numbers itself, right? So the runway seems to have extended. However, having said that, there are sparks of hope scattered across the basket. So it is not as if that it is entirely a dull set of earnings, right? There are reasons for hope and belief, for optimism in several pockets. I feel there has been quite some drag, especially by disappointments in several large cap and heavyweight players that is bearing very heavy on the index. But as we speak and as the results continue to come through, it is largely going to be a mixed bag with several pockets of opportunity and hope opening up towards the farther ends of the market cap. So the way we look at it right now, the industry leaders have set the tone and precedent for several sectors. Any result that could come in and buck this trend is, will throw a lot of spotlight on that specific company or stock in this perspective. So right now we remain cautious with the set of results that are coming in. We are not hoping for any big surprises. In fact, at this moment, we are just hoping that the remainder of results are not going to be as dull as the first set of results have been looking like.
Okay. Nirav, let's also talk about the IT sector, because we had the money control exclusive where the MD and CEO explained that they are planning to cut 2% of its global workforce, which will be impacting about 12,000 jobs in FY26, and that is not solely because of the AI-led shift productivity gains. But yes, the street has been quite cautious. Nifty IT index has seen about 1% decline in today's trade. But what is your assessment, and of course, what is your view on the entire IT pack and any stocks that particularly are positioned towards?
So the IT sector itself, especially Indian domestic IT and a large set of it that is export facing, continues to witness quite a series of headwinds, especially from the global demand standpoint. The macro outlook for global demand is pointing towards weakness. In fact, there's a lot of uncertainty stemming from economic slowdown and employment growth in the West, especially that remains a key destination for export of IT services. So we expect the trouble and challenge to continue looming over the sector for quite some time now, and in fact, it could even extend to a couple of quarters from here on. And like you rightly said, the job cuts that are underway, it is not exactly in response to AI-led productivity gains, but it is also part of what we view it as a restructuring for efficiency. Given the near to medium term outlook being weak, and in fact, larger players, like Infi, for instance, has also posted a good year-over-year growth, but the full year forecast has been really narrowed down. So the remainder of the year is also not seeming very promising for the IT sector, right? So it is in the best interest of the company, and quite rightly so, to undertake several operating efficiency measures, and one of which is job cuts. Although there's a lot of spotlight on the job cuts, that's not the only thing that these companies are looking at to prop up efficiency. While this is an important line item, companies, and especially large and mid IT companies, are focusing on very ruthlessly optimizing costs across all line items. So, in the way life stands right now, the outlook remains challenging, at least for the next 2 to 3 quarters.
That's right. That's right. Nirav, what about about let's scale back to once again to earnings season, because everyone was of the view that earnings downgrade cycle would slow down from here on, but so far it has been quite disappointing from India Inc. But what is your take? Do we expect a slowdown, or do we expect the momentum to continue from here on?
So we are expecting a slowdown in terms of downgrades, right? We are definitely, the worst has been behind us. There is very little room for disappointment from here on, right? Most pain and challenges have been effectively baked in. So while what we see in terms of market reaction may seem steep from a very near-term perspective, but if we could just zoom out and look at how the prices have been moving and how the valuations have been moving over the, let's say, past 1 or 2 quarters versus the past 8 quarters, you'd see that a lot of such pessimism has already been baked in. Downgrades have come through. The only point of contention is that the upgrades are not coming in sooner. A revival or a U-turn is not being witnessed sooner, and this also corroborates with the initial commentary at the start of this conversation, that there were hopes of revival in earnings and earnings-led upgrades coming through in this quarter itself. However, it seems like it's going to take slightly longer. So at this point, the question is not as much of an if as much as it is of a when. Right, and the answer to that when seems to be an extended runway, in wherein we are shifting the expectations and the burden of expectations largely onto the next quarter and the quarter after that. Especially considering that this quarter seems to be bucking that expectation that we had set out initially. So we are still structurally on the right track. Downgrades are mostly behind us. So, but we got to wait for a little bit longer and go through a certain plateau before we start seeing signs of an earnings-led upgrade coming in.
Okay, okay. Nirav, the consensus on the street used to be for banking sector, but you can see the rate cuts which have impacted the margins of the private lenders, and the management also expects the pain to be felt for another quarter or so. How are you positioned on the space? Do you believe that it is time to trim some of the positions for the banking sector itself?
So I wouldn't go to the extent to give a blanket call on the entire sector, because, of course, the sector at large is facing a headwind of margin pressures. But there are some banks, especially in the private segment, that are better positioned than the others. So I would say that we still remain positive on banking. but we remain selectively optimistic within the segment. There are a few large cap and mid cap private banking names that are offering a good margin of safety, which have exhibited strong underwriting capabilities and have a very strong deposit franchise that will hopefully help it tide over the margin shrinkage patch much better than the others. So there are selective opportunities. I wouldn't really look at the entire sector as a write-off, at least not immediately. These are sectoral headwinds that are cyclical in nature, but the question is, is it are there opportunities available? And it is yes. And the key indicators to look at would be the health of the balance sheet, underwriting capabilities, the size of deposit franchises, and the credit demand that is soaring from here on at a macro level as well. So despite margin shrinkage being a pressure, the overall size of the book can be expected to expand, which could potentially lead to a good uptake in bottom line earnings or net interest income. Even though the margin could shrink a bit, the income could grow meaningfully. Even other income is looking to become a meaningful share of the overall PNL. So we would be selectively optimistic on this space. It would be too early and perhaps jumping the gun to write off the entire sector.
Okay, okay. But if we bifurcate between the two, do you believe that PSU banks are still at a relatively advantageous position compared to private lenders at this point?
So PSU banks are at an advantage more so from a margin of safety from a valuation perspective. Uh, and versus their own time series, the balance sheets are looking indeed healthier, but it wouldn't be an apple to oranges comparison when we start looking at the growth outlook from an earnings perspective as well. Right. So both are having distinct advantages, but we believe that even private banks stand to benefit from much robust underwriting capabilities and their ability to cater to the growing credit demand on the back of reasonably healthy balance sheets and better good enough deposit bases, deposit franchises. Of course, the PSU pack, the PSB pack seems to be taking the cake there as well on the deposit franchise front, but there is not enough reason to choose one over the other. A bottom up approach is highly warranted from here on.
Okay, okay. Now that we spoke about banks and of course IT also, anything, anywhere that you're finding value so far in this earnings season, or how are you positioned at this point of time?
So not specifically from the earnings season perspective, but I feel that the earnings season itself has led to quite some bit of volatility in the markets at large, and in fact, a lot of global macro uncertainty and earnings volatility is reflected in FII interest also. So any sort of weakness in the market, and that is spread across the broader market without very strong structural reason at a bottom level, does indeed open up opportunities. There are a few segments that we are looking at with a lot of interest. So number one on the pack would be capital marketplace. So amid regulatory headwinds, amid volatility in volumes and several challenges that cap marketplace have been witnessing in the past, the entire pack has been subject to knee-jerk reactions, which also opens up opportunities for entry at much more reasonable valuation that pullback point. So very selectively within the cap markets space, we believe there's going to be opportunities for entry at much more comfortable valuations with reasonably better margin of safety, especially considering the earnings growth outlook and the entire outlook on a booming, a structurally booming business cycle being ahead of us. So cap markets is one. Another segment that we are closely looking at is non-lending, financial services entities. This could be the likes of asset management companies. I know it's an overlap with cap market plays, but for the distinct business model that it has, is looking very good at this point in time. There are several insurance companies that have started to look really good at this point in time. Now, apart from that, there are a few new age tech-led companies that have just started turning around the corner. The results have pleasantly surprised. They are attempting to get out of the woods finally. So there are a few new known names of tech-led new age companies that we believe will deliver a lot of value going ahead. And now that they have especially shown very strong signs of turning around the corner. So these are a few niche segments that we are looking at closely from an opportunity standpoint.
Okay. Nirav, how about the cement space? Because today we can see the entire cement pack is buzzing in the trade despite a muted market sentiment. And so far the earnings have also been fairly good. How are you positioned there?
So we are positive on cements. So cements are a part of. I mean, it is going through a multi-cycle structural growth story from here on. Of course, the usual levers, the usual tailwinds. You have capex cycle picking up. You have infra and development on the cards right at the center of capex budgets, especially public capex. In fact, cement companies have been in a consolidation mode and operating efficiency mode since quite a couple of quarters now. It's almost been 6 to 8 quarters that they have been upping their game in terms of efficiencies. And, input costs have also normalized versus what it was around 4 to 6 quarters back, which is being directly reflected in the margins as well. So we believe the case for cements to remain strong, especially against the backdrop where more near-term earning sensitive stocks continue to face ruthless reactions from the markets, and this is one of those steady grounds which will witness and be beneficiaries of sector rotations happening out of other highly, I would say, sensitive segments in the market. So there are a few things that are going good for the cement pack, structurally, also tactically. So we remain positive, neutral to positive on cements as a segment from a medium to longer term standpoint.
Okay, all right, Nirav, with that, we have to let you go. But thank you so much for your time, and we hope that we connect with you soon.
Thank you, Lovisha.
All right, let's take a quick check of the markets, how the markets stand up at this point of time. If you look at Sensex down about 120 points, Nifty also below that 24,850 mark, but still above the 24,800 levels, where we open with a loss below that levels at this point. But yes, India Wix, that shows sharp uptick of about 6%, has now cooled off, and it's showing an uptick of about just 4% at this point. What continues to remain resilient in this market is your Nifty Auto Pack, showing a gain of about 0.4%. Nifty FMCG also doing well with about 0.5%, 0.5% gains coming in there. Nifty Pharma and PSU banks also continue to ride in this subdued market sentiment. On the other hand, Nifty IT leading the losses from the sectoral indices, Nifty Metal with about 0.5% gains, 0.5% loss, and Nifty Private Banks and Nifty Realty. Nifty Realty is seeing a sharp cut of about 2%, the top sectoral loser at this point. But yes, the much support that came in from the markets, that came in from the broader end of the markets, because we can see mid-cap and small-cap indices outperforming the headline indices, both of them in the positive terrain at this point. In mid-cap with about 0.5% gains, and small caps also with about 0.3% gain. But yes, that's all for the markets for now, but we'll watch out if there is any substantial recovery in the second half of today's trading session. But with that, we have come to an end of this edition of Opening Bell. Don't forget to tune in at 3:30, and we'll watch out how the market is developed and what the stocks did grab limelight throughout the trading session. But until then, signing off.